Hi there, my name is Showit and this is Finance Central. We go about our day-to-day lives focusing on what affects us directly. We worry about our jobs, our family, our friends, our neighborhood, etc. But there are some bigger things like the state of the economy that also affects how our lives will turn out to be. The state of the economy is how a country uses money and resources to produce goods and services. Whether the economy is growing, shrinking, or standing still, it influences stock performance. And if you have money invested in the markets, you need to pay some attention to the state of the economy. To understand the impact of the economy on your portfolio, I'd like to look at how the different economic factors affect stock prices. Please do not forget to like this video and subscribe to my channel to help me grow on YouTube. Also leave comments below if you wish to add context or dive deeper into this topic. When there is a bull market, the investor confidence is high and stock prices rise. Most stock holdings will increase in value. Generally, a bull market exists if the market has risen 20% or more above its near-term lows. On the other hand, when there is a bear market, investors start becoming nervous, which leads stock prices to decrease and many stocks become undervalued. This is a great opportunity to scoop up good companies for bargain basement stock prices if you're smart enough to keep some cash on hand. A bear market should not be confused with a correction, which is a short-term trend that has a duration of fewer than 2 months. Fun fact, the bear market phenomenon is thought to get its name from which way the bear attacks its prey, swiping its paws downward, whereas a bull market is named after the way in which the bull attacks by thrusting its horns up in the air. In any case, there could even be a market bubble when investments are extremely overvalued. That is, their prices are much higher than what they're worth. Once people realize that stocks cost too much, the bubble bursts and prices plummet dramatically. This can be disastrous for portfolios where investors have bought in at the highest price and kept holding those investments when prices hit rock bottom. Then there is inflation, which affects the markets. When there is inflation, prices are rising and purchasing power is falling. Every dollar buys less than it used to. If inflation spikes too high, people can't afford to buy as much as they could before, and corporations may start to lose sales, causing stock prices to drop. This creates a drop in investment values. If there is low inflation, it indicates a healthy economy, which can be good for the stock market and individual stock prices. For now, the United States tries to target about 2% inflation every year. The Federal Reserve, or the Fed, controls the interest rates. When interest rates increase, stock prices tend to decrease. However, some types of corporations like banks or mortgage companies fare better when there is an interest rate hike, and so do their stock prices. When interest rates drop, stock prices usually rise. The gross domestic product, or the GDP, measures the economy as a whole and lets us know if it is growing or shrinking. The United States has the highest gross domestic product in the world, ahead of China and Japan. But it ranks 5th in the world for GDP per capita, with smaller nations like Luxembourg, Ireland, Switzerland leading the rankings. I will talk more about macroeconomic factors that affect personal finance in the videos to come. For now, please just share these with your friends and family. That is it from me for now. I shall see you in the next one. Goodbye and have a wonderful day.